Did you know that more than 60% of Californians already say taxes are their biggest financial stress? Yet in 2026, many families could lose thousands of extra dollars without earning a single dollar more. What's truly shocking is that these costs won't come from one big tax hike you can easily spot. They'll come quietly, hidden inside new rules, adjusted thresholds, and small legal changes most people will never read until it's too late. Right now, new California tax laws have already been passed, and they're set to take effect in 2026. These laws don't just target the ultra-rich or big corporations. They hit working families, retirees, side hustlers, and homeowners, people who believe they're financially safe. A tiny change in how income, property, or even everyday spending is taxed could slowly drain your savings month after month right under your nose. Here's the uncomfortable truth. By the time most people realize what's happening, the money is already gone. That's why this video matters. We're breaking down 10 shocking California tax laws you need to know now before they quietly reshape your budget, your plans, and your financial future. Stay with us because some of the most dangerous changes are the ones no one is talking about.
Number 1. Silent Income Bracket Trap. At first glance, California's updated income tax brackets for 2026 may look harmless, even fair. Officials say they're adjusted for inflation, which sounds like a good thing. But here's the catch. Inflation adjustments don't always protect your real income. Many Californians are getting small raises just to keep up with higher rent, groceries, and fuel. On paper, that looks like growth. In reality, it's survival. Yet that slight bump can quietly push you into a higher tax bracket, meaning the state takes a bigger share of money that already feels stretched thin. What makes this change especially dangerous is how invisible it is. There's no dramatic announcement, no headline screaming tax hike. Instead, it shows up later, when your take-home pay feels smaller, your refund disappears, or you suddenly owe money at tax time. Middle-income earners are the most exposed here. You may think, I didn't get rich this year, but the tax system doesn't care how far your paycheck actually goes. It only sees the number, not the pressure behind it. The practical impact is real and immediate. Families budgeting tightly may need to rethink withholding, adjust savings plans, or prepare for smaller refunds. If you rely on annual refunds for emergencies or debt payments, this shift can hurt badly. The smartest move is awareness, knowing that a small raise doesn't always mean progress. In 2026, earning more does not always mean keeping more, and this silent income bracket trap is one of the first ways California's new tax laws begin draining savings without warning.
Number 2. Side hustle taxes just got serious. Over the past few years, side hustles have become a financial lifeline for millions of Californians. Driving part-time, selling online, freelancing, or earning through social media often feels informal, almost like extra money. But in 2026, that mindset could become dangerously expensive. California is tightening how side hustle income is tracked and taxed, and the changes are far more aggressive than most people realize. The biggest shock is visibility. New reporting thresholds and data sharing rules mean even small, irregular earnings are now easier for tax authorities to see. Money that once flew under the radar is being flagged automatically. Many people don't set aside taxes for these gigs because the income feels minor or inconsistent. That's where the problem begins. When tax season arrives, Californians are discovering they owe hundreds or even thousands they never planned for, sometimes with penalties added on top. The real danger isn't paying tax itself, it's being unprepared. Side hustlers often forget deductions, miss quarterly payments, or underestimate how quickly small earnings add up over a year. A few $100s a month doesn't feel like much until the bill arrives all at once. The practical solution is simple but powerful. Track every dollar, set aside a portion immediately, and understand that extra income is still taxable income. In 2026, side hustles are no longer casual. If you don't treat them like a real financial stream, California's new tax rules will treat them like a costly mistake.
Number 3. Family wealth transfers are getting more expensive. For decades, many Californians believed passing wealth to their children, whether through property, savings, or assets, was a smart way to secure the next generation. But in 2026, new tax rules are quietly reshaping that idea. Family wealth transfers are becoming more costly, more complex, and far less forgiving, especially for middle-class households that don't see themselves as wealthy. The biggest shock comes with inherited property and gifted assets. Changes in how value is reassessed can trigger higher tax obligations the moment ownership changes. A home that's been in a family for decades may suddenly be taxed closer to today's market value. For heirs, this can mean ongoing costs they never expected and sometimes can't afford. Many families are discovering that what looked like a generous inheritance quickly turns into a financial burden. The real danger is timing. Most people plan transfers late, assuming rules will stay the same. But once laws change, options shrink fast. Waiting can cost families tens of thousands over time. The practical takeaway is preparation. Understanding how and when assets are transferred matters more than ever. Early planning, proper documentation, and knowing the long-term tax impact can protect savings and reduce stress. In 2026, passing wealth without a strategy isn't just risky, it can quietly drain the very legacy families worked a lifetime to build.
Number 4. Property taxes are quietly resetting. Homeownership in California has long been seen as a form of financial security, but in 2026, that sense of stability is starting to crack. New rules around property tax reassessments are quietly changing how much homeowners owe each year, and many won't notice until the bill arrives. Even if you haven't bought or sold anything, your property value may be reassessed under updated guidelines that reflect today's much higher market prices. What makes this especially unsettling is how indirect the change feels. There's no letter that says tax increase approved. Instead, reassessments happen through technical triggers: ownership adjustments, renovations, inherited properties, or classification updates. A small home improvement or a family transfer can suddenly push your property into a new valuation category, raising annual taxes permanently. For homeowners already struggling with mortgages, insurance, and utilities, this can quietly tip budgets into dangerous territory. The long-term impact is where the real damage happens. Higher property taxes don't just affect one year, they compound over time. Seniors on fixed incomes and families who bought years ago at lower prices are particularly vulnerable. Many assume their taxes are locked in, only to discover they're not as protected as they believed. The smartest move is awareness. Reviewing assessment notices, understanding appeal deadlines, and knowing what triggers reassessment can make a real difference. In 2026, owning a home doesn't automatically mean financial safety, and California's evolving property tax rules are one of the most silent yet powerful ways savings begin to drain.
Number 5. Retirement income isn't as safe as you think. Many Californians head into retirement believing their income is finally predictable. Pensions, Social Security, and retirement account withdrawals are often seen as protected money, carefully planned and relatively stable. But starting in 2026, changes in California's tax approach are quietly putting retirement income under more pressure, catching many seniors completely off guard. The issue isn't one big tax increase, it's how different retirement streams are treated and combined. Certain withdrawals can push retirees into higher effective tax levels, even when their lifestyle hasn't changed. For people living on fixed incomes, this is especially dangerous. A few extra dollars taken each month can feel manageable at first, but over a year it can significantly reduce savings meant to last decades. Many retirees only realize the problem when their refund disappears or a tax bill shows up instead. The emotional impact is just as serious as the financial one. Retirement is supposed to be about stability, not constant recalculation. Yet these changes force seniors to rethink withdrawal timing, account types, and long-term plans. The practical takeaway is planning, not panic. Understanding how and when to withdraw funds and recognizing that not all retirement income is treated equally is now essential. In 2026, retirement security isn't just about how much you saved, it's about how smartly you access it, because even small tax shifts can quietly shorten the life of your nest egg. Before you scroll away, tell us this: which tax change worries you the most? Drop the number in the comments or share how these laws could affect your family. If this breakdown opened your eyes, watch our previous video where we uncovered more changes most people completely miss. We put hours of research and effort into making these videos so you can stay protected and informed. Please support our work by subscribing. It's just one click, but it helps us more than you know.
Number 6, capital gains are taking a bigger bite. For many Californians, selling an asset has always felt like a smart financial move. Whether it's stocks, real estate, or even digital investments, capital gains are often seen as reward money, the payoff for taking risks or planning ahead. But in 2026, California's updated tax approach is quietly making those rewards far more expensive than most people expect. The danger lies in how gains are calculated and layered. Even if you hold an asset for years, selling it at the wrong time can push you into higher overall tax exposure. Inflation-driven price increases make profits look larger on paper, even when the real buying power hasn't changed much. The tax system doesn't adjust for that reality. As a result, people may owe more simply because values rose over time, not because they actually became wealthier. This hits everyday investors the hardest. Someone selling stocks to cover medical bills, tuition, or retirement needs may suddenly face a tax bill that eats into the purpose of the sale itself. Real estate sellers, especially those downsizing or relocating, can also be caught off guard when exemptions don't cover as much as expected. The emotional shock often comes after the deal is done, when there's no easy way to undo the damage. The practical lesson is timing and awareness, knowing when to sell, how gains interact with your other income, and understanding that profit doesn't always mean extra cash is critical. In 2026, capital gains are no longer a simple win, and without careful planning, California's tax rules can quietly turn smart financial decisions into painful surprises.
Number 7. Popular deductions are slowly disappearing. For years, many Californians have relied on tax deductions to soften the blow of high living costs. Mortgage interest, work-related expenses, education costs, and family-related credits have often been the difference between a manageable tax bill and financial stress. But in 2026, several of these familiar deductions are being reduced, capped, or quietly phased out, and the impact is far bigger than it sounds. What makes this change so dangerous is expectation. People plan their finances assuming certain write-offs will still be there. When those deductions shrink or vanish, taxable income suddenly looks much higher, even though real expenses haven't gone down. Families with children, homeowners, and professionals who pay out of pocket for work costs are especially exposed. Many only realize something has changed when their refund is hundreds or thousands lower than usual. The ripple effect hits monthly life, not just tax season. Smaller refunds mean less money for emergency savings, debt payments, or catching up on rising bills. For households already living close to the edge, this can feel like a step backward with no clear explanation. The system doesn't warn you, it simply recalculates. The practical takeaway is to stop relying on old assumptions. Reviewing which deductions still apply, adjusting budgets early, and preparing for smaller refunds can prevent shock later. In 2026, the tax break you're counting on may no longer exist, and understanding that reality ahead of time can make the difference between staying stable and slowly losing ground. Number 8. Small business penalties are adding up fast. Running a small business in California has never been easy,
But in 2026, it's becoming even more unforgiving. New tax-related compliance rules are quietly raising the risk of penalties, fines, and unexpected costs, especially for small business owners who don't have full-time accountants. Even profitable businesses are finding themselves losing money, not from lack of sales, but from missed details. The most troubling part is how minor the mistakes can be. Late filings, incomplete forms, misclassified workers, or outdated registrations are now more likely to trigger penalties. What once resulted in a warning can now lead to automatic fines. For small business owners juggling inventory, payroll, and rising operating costs, these penalties feel less like enforcement and more like punishment. The financial damage doesn't stop at the fine itself. Penalties often come with added interest and follow-up requirements, pulling owners away from growing their business and into paperwork battles. Many entrepreneurs don't realize they're out of compliance until they receive a notice. By then, the cost has already piled up. This creates stress, uncertainty, and a growing fear of making the wrong move. The practical lesson is preparation and organization. Keeping records clean, staying updated on filing deadlines, and understanding new requirements can prevent unnecessary losses. In 2026, small businesses aren't just taxed on profits, they're taxed on mistakes. And without proactive planning, those mistakes can quietly drain savings faster than any single tax increase.
Number 9. Everyday living is becoming a taxable habit. One of the most overlooked changes in California's 2026 tax landscape isn't tied to income, property, or investments. It's tied to how you live your daily life. New and expanded usage-based and environmental taxes are quietly turning ordinary habits into ongoing financial leaks. You won't see them labeled clearly as tax increases, but you'll feel them every single month. These costs show up through energy use, transportation choices, and consumption patterns. Driving, heating your home, charging devices, or relying on certain utilities may now carry additional layered charges. Individually, they seem small, just a few extra dollars here and there, but over time they stack up. For families already dealing with higher food, rent, and insurance costs, this creates a slow but relentless squeeze on monthly budgets. What makes this especially frustrating is the lack of control. Unlike income taxes, you can't easily plan around these costs. You still need to commute. You still need electricity. You still need to live. Low and middle-income households feel this the hardest because these expenses take up a larger share of their income. Many people won't even realize they're paying more in taxes. They'll just feel like life is getting more expensive without explanation. The practical takeaway is awareness and adjustment. Monitoring utility bills, understanding where extra charges come from, and making small efficiency changes can help reduce the damage. In 2026, everyday living itself is becoming a taxable activity, and without noticing these hidden drains, California residents may lose far more over time than they expect.
Number 10. Local taxes are quietly stacking the damage. The final shock in California's 2026 tax changes doesn't come from the state alone. It comes from cities and counties quietly adding their own layers. While most people focus on statewide tax laws, local governments are gaining more flexibility to introduce fees, assessments, and targeted taxes that slowly pile on to your cost of living. Individually, these increases seem minor. Together, they can become financially overwhelming. What makes local taxes especially dangerous is how fragmented they are. One city adds a transportation fee. Another increases sales or service charges. Counties may adjust special assessments for schools, infrastructure, or public services. Because these changes are spread across different bills and notices, most residents never see the full picture. They just notice that everything costs a little more, month after month, without a clear reason why. Renters and homeowners alike are affected.
Landlords often pass these costs on to tenants, while homeowners face higher annual charges that never disappear. Unlike income taxes, local taxes don't always scale with earnings. That means someone earning the same salary can end up paying significantly more just because of where they live. Over time, this creates financial pressure that's hard to escape without relocating, something many families simply can't do. The key takeaway is vigilance. Reading local notices, understanding new city-level measures, and factoring these costs into long-term planning is now essential. In 2026, the biggest tax threat isn't one massive increase, it's dozens of small local charges stacking together, slowly draining savings while staying just below the public radar. As we've seen, California's 2026 tax changes aren't about one dramatic law or a single massive increase. They're about layers, small adjustments, quiet rule changes, and hidden triggers that, together, can slowly drain savings from people who are already stretched thin. From income brackets and side hustles to property, retirement, and everyday living costs, these laws affect real lives, not just spreadsheets. The most dangerous part isn't the amount, it's how easy it is to miss until the damage is already done. What makes this moment especially important is timing. These laws are already passed, which means the window for preparation is now. Waiting until tax season or until a bill arrives leaves you with fewer options and more stress. Awareness is your first line of defense. Understanding how these changes work allows you to adjust expectations, plan smarter, and avoid being caught off guard. Even small actions, tracking income, reviewing assessments, or budgeting differently, can protect you from long-term financial strain. This isn't about fear, it's about control. Taxes will always exist, but surprise taxes don't have to. The people who suffer the most are often those who believe they're unaffected: middle-income earners, retirees, and families doing their best to stay afloat. Knowledge shifts the balance back in your favor. When you know where the pressure points are, you can respond instead of reacting. California's tax system is becoming more complex, not simpler, and in 2026, complexity itself becomes a cost. Staying informed, asking the right questions, and planning ahead isn't optional anymore, it's essential. The goal isn't just to survive these changes, but to protect your financial future in a system that quietly takes advantage of those who aren't paying attention.